Did you ever think that selling puts was an easy or guaranteed way to earn income? If so, you'll want to think again and watch this video until the end because not only will I cover the dangers of selling puts, but it'll also give you examples on how to successfully navigate the trade. My name is Rick Orford, and I've been trading stocks and options since 1999. I've seen a lot of ups and downs in that time, including the dot-com bubble, the financial crisis, and of course most recently, the pandemic. In this video, you'll learn the 5 dangers of selling put options, how to mitigate them, and actually tilt the odds in your favor to create a consistent income. There's a lot of information, and it's full of ideas that I use to sell puts, so definitely watch it to the end. And of course, if you have any questions along the way, don't hesitate to reach out by leaving a comment or a question, or of course, find me live on my Discord server. So without further ado, let's get started. If there's one thing that you'll want to know about selling options is that while it's rare, the buyer can exercise the contract at any time before it expires. If you sell a put, the holder can sell you 100 shares of an underlying security at a specific price before expiration, regardless of the stock's price, even if it drops to zero. The buyer can exercise a put option and assign at any time. Upon assignment, you'll buy 100 shares of the underlying security at the strike price for every contract you sold. For example, if you sell a put on a stock with a $200 strike and the stock drops to $190 or $150 or even $1, well, the buyer now has the right to sell you 100 shares at $200 each. This can be a significant risk, but it's manageable with a proper strategy. Now, it's important to remember that only a small percentage of options are indeed exercised early, but it can happen. One common reason for early exercise is when the company declares a large dividend. For example, let's say a company's stock trades at $100 and they declare a $5 dividend. When the stock trades ex-dividend, and all things being equal, the dividend will be subtracted from the stock price, making the stock drop to $95. And that might make the option in the money. Speaking of which, early exercise is also more likely if the put option is deep in the money as it approaches expiration, especially if the time value left in the option is minimal. Now, if the stock moves towards the strike price with significant time left to expiry, it usually makes sense for the holder to sell the option at a profit rather than exercise it. For example, if a put option with a $100 strike is in the money by $10 and has perhaps 6 weeks until expiration, well, the time value could add another $8 or $9, making the premium around $18 to $19. So in this case, selling the option could result in a higher profit than exercising it. Now, if a put option is exercised and you are assigned 100 shares of the underlying stock or ETF, you'll need cash or margin to make that purchase. And declining markets can affect your buying power or margin. And when you have those shares, you can keep them, sell them, or even sell covered calls on them. Another danger in selling puts is overcommitting by selling too many contracts, especially on margin. Now, while your brokerage might offer you substantial margin, using it increases your risk. If there's a market sell-off, your positions will also likely drop, leading to a sort of domino effect that includes assignment, margin calls, and perhaps even forced liquidations. So it's important to consider each contract's position size in your portfolio. For instance, let's say you have a well-diversified portfolio and the average position size is, say, $5,000. Well, in this case, think about selling a put with a $50 strike price, which works out to a $5,000 position. If you sell 2 contracts, that works out to a $10,000 position. Ignoring this can result in paying a higher price for stocks than they're actually worth and ending up with a heavily weighted position if you're assigned. Later on, I'll show you an example of someone who actually made a bunch of money, but you'll have to ask yourself, based on the number of contracts, strike, and position size, would you have done it? Stick around for that because I think it's a really interesting trade example. We'll call it a case study. If you had a crystal ball that told you that selling a specific put option had a 99% chance of expiring worthless, would you do the trade? I mean, a 99% chance sounds like a sure thing, right? However, in reality, predicting the outcome of an options trade isn't often that simple. Understanding your odds before entering the trade not only helps you sleep better at night, but also leads to more profitable decisions. So how do you assess your chances of success? Well, one way is to use an options-friendly broker like Interactive Brokers. For instance, if you had a favorite stock in mind, you can experiment with different expiration dates and strike prices. When you select a put option to sell, the platform can estimate your probability of profit. For example, after setting your parameters, Interactive Brokers might show you that there's a 70% chance of making a profit on a particular put option. But remember, a 70% chance of profit means there's about a 1 out of 3 chance of loss. And that's why I prefer selling puts with an 80 to 90% chance of profit. And finding these can be time consuming, and when you do find one, the premiums are usually very low. And this is why using an option screener can help you to scan the entire market based on specific filters, saving you time and energy. 2 screeners that I recommend are Option Samurai and Bar Chart. Now, both provide tools to scan for options with a high probability of expiring worthless, and they can quickly narrow down your choices. Option Samurai, in particular, is user-friendly for beginners. You can log in, hit Compose New Scan, select Naked Put from the drop-down menu, and perhaps adjust the settings if you like the expiration date and the probability of expiring worthless, and then hit Run Scan. In seconds, you'll have a list of potential trades that meet your criteria. The other option scanner that I use daily is offered by a company called Bar Chart. It's kind of like my Swiss Army knife of investing because it does so much more than give me ideas for options trades. It's also less expensive than Option Samurai and gives me a 1-month free trial. The only thing is that it has a little bit of a learning curve. So let's say you want to scan for put options to sell. We know that we want to sell out of the money put options. So here's what you can do. If you'd like to support the channel, scan this QR code and click on Options at the top, then click Naked Put. This gives you a default screen that includes lots of information like the underlying security, trading price, expiry date, strike price, bid price, delta, and my personal favorite, OTM probability. And you can click on any of these headings to sort the data. You can also save your screen by clicking the Save Screener button. Just give it a name, and if you like, it'll even email you the results at a predefined time during the day. Okay, so let's get back to the results. Now, these are the results based on the default filters. We can adjust them to get a more specific match that's right for you. First, we can set the expiration days to a little more than the default, let's say 100 days away. That'll give us lots of time to take advantage of theta decay so that we can close out the trade profitably, perhaps early, or adjust if we need to. I'll also click Deep OTM. This will search for put options that are at least 25% out of the money. This is a safety feature because the stock would have to drop at least 25% before you'd have to start considering a plan B. Next, we have delta. Delta is one of the options Greeks, and it's crucial in understanding risk. You can use it to quickly judge the chances of an option expiring in the money. 0.2 to 0.4 translates to a 20 to 40% chance of the option expiring in the money, or a 60 to 80% chance of the option expiring worthless. While delta provides a quick estimate of risk, I preferred Barchart's OTM probability feature. This is proprietary to Barchart, and you won't find it anywhere else. Okay, so I'll enter 75 here to signify a 75% chance or more of it expiring worthless, and I'll remove delta. And to be a little greedy, I'll set the bid price to $1. That'll make sure that I make at least $100 per contract on any of the trades. Okay, so let's hit see results so that we can see what happens. So there you have it. If you use an option screener to find options with a high chance of expiring worthless, you'll have a better chance of finding winning trades. It also means that you'll significantly cut down the time spent analyzing potential trades, which is crucial for active traders. But remember, at some point during your trading career, you'll likely get assigned on an option. And that's why you want to be sure to sell puts on stocks you'd actually like to own and at a price you'd be happy to buy them at. When selling puts, there's a right and wrong time to do it. Option premiums are much higher during times of volatility and lower when markets are calm. Volatility increases the uncertainty in the market, which leads to higher premiums as traders demand more for the added risk. For that reason, it's often better to buy options when volatility is low and sell options when volatility is high. For example, if there's an event like an earnings report, or an economic announcement like an interest rate decision, or even a geopolitical event, all these can cause volatility, and the premium will go up or down depending on how the stock trades. So when selling puts, it's often best to sell them during those times. Or you can start your search for options with a higher implied volatility and consider selling those. So let's go back to the filters and add implied volatility, and now we're going to set it to high to very high. This will ensure you only get options trades with a high implied volatility. And since these are higher risk options, we'll also want to dial up the profit probability. So I'll enter here 85 to get results with an 85% chance of expiring worthless. And now we'll hit see results and see what we got. And there you have it. We now have 5 put options out of the entire market that fit the bill. And today they all happen to be Tesla puts. Now, if you're happy to potentially own Tesla at one of these prices, then one of these trades could work for you. But if you don't find what you're looking for, remember that just because you want to sell a put option today doesn't necessarily mean that there is a good trade available for you or within your specific parameters. You might need to wait an hour, a day, or maybe 2 or 3 days for a trade to become available. And that's why I think it's a good idea to save the screener and have it email you. So be patient. But let's say for the sake of argument, let's say you're happy with this trade right here, the Tesla put with the $160 strike expiring September 20th. And you sell it and collect $123 for the contract. Then let's say markets start to move down and Tesla's stock trading price starts to approach the strike. Well, what do? Well, that leads me to my 5th and final danger of selling put options, and that's not rolling or exiting your trade in time. If Tesla moves down towards the strike, you might consider rolling it before it trades below the break-even point. Rolling your trade means closing out your short put by issuing a buy-to-close order on the put that you sold, and then selling another put option on the same asset at a different strike price, perhaps with another month or two to expiration. Knowing your break-even point is also very important in options trading so that you get a clear idea of an exit point. To calculate your break-even point on a short put, simply subtract the premium from the strike price. If the stock trades below the break-even price, your short put will start to lose money. So the key is to roll your trade at a point that makes sense for you to reduce the loss. So let's fast forward a few days and we see that Tesla's stock is indeed moving down. Let's have a look at what we can do to roll the trade and protect the premium. Again, we'll go back to bar chart, type in Tesla, and visit its options pricing page. We'll change the expiry date now to September 20th, and I'll add a few strikes so that you can see more pricing. And there we have it. Now we see the premium on the Tesla 160 put expiring September 20th now costs $3.25. And if we look at delta, we can infer that there's now about a 13% chance it'll expire in the money, or an 87% chance it'll expire out of the money. Still decent odds, but here's what I might do next. Let's change the expiry to the next month and find a put option with a premium around $3.25 that we can sell. So I'll change the expiration date to October 18th and scroll down, and we can see here that this Tesla put has a $145 strike and a premium of $3.45. And not only that, the delta is only 10, and that means there's a 90% chance that this option will expire worthless. And that'll happen as long as Tesla stays above $145 by expiration. So to roll this trade, you'd initiate a buy-to-close order on your short put and pay $3.25 a share, meaning you're now going to lose $202 a contract. And then you'd sell the Tesla 145 put expiring October 18th for $3.45 a share, or $345 a contract. And your net premium is now $1.43 per share, or $143 per contract. And you can keep doing this until the option expires worthless. On the other hand, what if the stock went the other way? What if it went way above the strike price? Well, I wanted to discuss this example earlier because someone in my Discord group asked exactly this. This guy was short 4 AMD puts with the $137 strike, and there was 2 days left to expiry. Now, he originally collected $1,477 in premium at the start of the trade. And the stock shot up almost 8% to trade around $149, well above the 137 strike. And guess what happened to the premium? Well, it crashed more than 95%. In other words, he could close out his trade for 95% less than the original premium. He could issue a buy-to-close order for just $71 and make a little over $1,400. And he was wondering, should I do this? Well, as I said to him, of course I would. And he did. And now he could move on to his next trade. And in case you're wondering, if I can take some chips off the table to crystallize, say, 70 or 80% of the premium, why not? It's a guarantee. Because today there's not much guaranteed these days, right? But there is one thing I wonder, though. What would have happened if AMD had gone down instead of up? That we'll never know. But one thing we will know is that that would have worked out to a $54,000 position. And that leads me to one final idea. Some brokerages, like Interactive Brokers, allow you to set profit-taking and stop-loss orders. I can't stress enough how important it is to consider that as part of your trading strategy. When you enter a trade, Setting a stop loss, saying around 50% of the potential gain, can help protect you against a larger loss. And a profit-taking order, say around 60, 70, 80% of the premium, well, that can crystallize your profits faster, all while you're out doing other things. Now, remember, a stop loss and profit-taking order usually translates to a market order, meaning some slippage could occur during times of higher volatility. So you might not always get the specific price that you hoped. So there we have it. I hope you enjoyed my video outlining the dangers of selling put options, and more importantly, what you can do to help ensure a profitable trade. As usual, if you have any questions, don't hesitate to leave a comment below, and I will answer it. And of course, if you'd like to join me live in my Discord community, the link is in the description. I'd love to see you there. Thank you so much for watching, and I'll see you in the next video.